Today's first scenario focuses on a recent graduate with a hefty amount of student loan debt. They're eager to start building wealth through investing, but unsure how to balance paying down that debt with the desire to grow their money. Taylor, I imagine this resonates with a lot of people in their 20s and 30s. What are your initial thoughts?
Absolutely, Alex. I know so many people feeling this exact pressure. It feels like a catch-22. You know you should be investing early to take advantage of compounding interest, but that mountain of student loan debt looms large. It's tough to know where to prioritize.
Precisely. So let's get to the heart of it with a couple of key questions. Sam, first, how can a financial advisor help someone in this situation prioritize between aggressively paying down their student loan debt and starting an investment portfolio?
A good advisor starts by understanding the individual's entire financial picture, their income, expenses, debt load, risk tolerance, and long-term goals. Then they analyze the interest rates on the loans. High-interest debt, like credit cards, usually takes priority. Student loans can be a bit more nuanced. For example, if the interest rate on the loan is relatively low, say 4%, and the expected return on a diversified investment portfolio is potentially higher, it might make sense to allocate some funds towards investing while still making consistent loan payments.
So if I understand correctly, it's not always a black and white pay off all debt before investing situation.
Exactly. It's about finding the optimal balance.
So, the money you're using to pay down debt could potentially be earning you a return in the market.
Right, that makes sense. But what about the psychological benefit of being debt-free? I know for some people, that peace of mind is priceless.
Absolutely, Taylor, that's a valid point. A good advisor will also consider the individual's emotional comfort level with debt. If the debt is causing significant stress, it might be worth prioritizing repayment, even if it means slightly lower potential investment returns. It's about finding a strategy that aligns with both financial and emotional well-being.
That leads us nicely into our second question. Sam, what are the potential long term implications of choosing different student loan repayment strategies? Our reference article mentioned income driven repayment options. Can you elaborate on those?
Sure. Income-driven repayment plans base your monthly payments on a percentage of your discretionary income. These plans can be helpful for recent graduates with lower starting salaries. However, it's crucial to understand the long-term implications. Because payments are lower, you'll likely accrue more interest over the life of the loan.
So, lower monthly payments now could mean paying more in the long run.
Potentially, yes. But there are scenarios where income-driven repayment makes sense, particularly if it allows you to start investing and potentially earn a higher return than the interest accruing on your loans. An advisor can help you navigate these complexities.
Excellent points, Sam. So, to recap, balancing student loan repayment and investing is a nuanced decision. The best approach depends on individual circumstances, risk tolerance, and long term goals. It's not a one size fits all answer, which is why seeking professional advice can be so valuable. In the meantime, listeners, if you're grappling with student loan debt and wondering how to start investing, take some time to evaluate your repayment options. Consider talking to a qualified financial advisor who can help you create a balanced plan that aligns with your unique situation.